This is Nick here for Merk Research, and I'm about to go through some highlights from my S&P 500 chart book. I have 7 charts to go through today, 1 chart for each of the following. I'll cover the fundamental or valuation backdrop, the U.S. business cycle, global growth, credit markets and financial conditions, market breadth, market sentiment, and historical returns for the S&P 500. As usual, I'll start with my conclusion, which is that I see a mixed picture. I'm cautious on the longer-term outlook, but relatively constructive near-term. For me, things are always in a probabilistic framework. Nothing is black and white, and I'll talk a little bit more about that at the end. Let me add the disclaimer that I don't have a crystal ball. No one does. The goal for me is to try to keep my eyes open to what's going on out there based on what I think is the relevant data. That's not to say there aren't important considerations beyond what I'm going to cover today. There are, but what I'll cover is maybe best thought of as a starting point by reviewing some basics. I'll plan to expand this presentation to cover a broader array going forward. So to put things into some context, let me start with a longer-term valuation or fundamental type indicator. And let me explain what we're looking at here. The gray dotted line is a proxy for aggregate equity allocation. It's the market value of U.S. equity divided by the total market value of U.S. equity and debt. The data comes from the quarterly Federal Reserve Z1 report, and currently the reading is 42.8%. The axis here is inverted, so higher allocations to equities are lower on this gray line. The black line is the subsequent 10-year annualized return on the S&P 500. So the data is only available to December of 2007 because we know with certainty now what that subsequent 10-year return starting from September 31st, 2007 is. The annualized rate was 6.18% through this past December of 2017. And what you can see visually here, and what the regression analysis suggests, is that the equity allocation has a strong relationship to the subsequent 10-year return. All we can say is that historically there's been a relationship. It's really not meant to be a forecasting tool. But if you put any faith in the idea that it can tell us something about what might happen going forward, because this equity allocation is relatively high, right now at 42.8%, based on the historical relationship, it suggests the subsequent 10-year annualized returns from today could be relatively low. Based on history, it suggests returns might be somewhere between negative 3% and plus 5% annualized. Now that's a wide range. Again, this is not meant to be a crystal ball, but the point is that it suggests that returns might be relatively low over the 10-year forward-looking period starting today. So I'm somewhat cautious on the 10-year outlook for U.S. equities at this particular moment in time from the current price levels. What would get me more positive on this chart and on the longer-term outlook for stocks is to see the aggregate equity allocation decline. So to see this gray line move higher, meaning lower aggregate equity allocation, I'd likely start to get quite positive on the longer-term outlook if we saw the allocation fall below the 30% level, which is around here. That might suggest, based on the historical analysis, roughly a 7 to 14% subsequent annualized return based on the regression analysis. Now, let me put this in the context of what else is out there that's like this. So some analysts, particularly sell-side analysts, like to use PE ratios. Some analysts like to use the so-called Buffett indicator, which is basically U.S. equity market cap divided by U.S. GDP. I think this indicator is better than those for a few reasons. One reason is because the data is very robust. It comes from the Federal Reserve's Z1 report, whereas when you get into discussions about PE ratios, there is always debate about whether forward PEs or trailing PEs are more relevant, whether they need to be cyclically adjusted, the accounting of the earnings number. There's debate about that. Then do you take into consideration price to sales or price to book? So all these things make that discussion very difficult. The second point is that this data goes back to 1945. So there's a large sample size, much longer time series than those other types of analysis that I mentioned. And then the third point is that the regression analysis, the math, suggests that this relationship is much stronger compared to those other types of analysis. The R squared for this regression is 86. The R squared of the sell side PE ratio analysis that I've seen is 42. But even given that I think this is a superior way of looking at things, at fundamentals, at valuation, compared to those PE ratio analysis or Buffett indicator type analysis, I think its predictive power is limited. So I want to make sure to get that point across. All right, let's look at the stock market in relation to the U.S. business cycle. We have a separate video series focused just on the U.S. business cycle. Here I'm showing the Conference Board's leading economic indicators index. That's in gray. And the way I show that in the business cycle videos is on a year-over-year rate of change basis. This is the absolute index level that we're looking at here. And then the S&P 500 is in black, and the U.S. recessions are marked in the blue bands here. So the leading economic indicators index is moving higher. The S&P is pretty much moving higher in lockstep with it. All we can say is that the leading economic indicators are not providing a headwind. They appear to be neutral to positive as a backdrop for stocks. It is, of course, possible for the S&P to start falling before the LEIs roll over, and that very well may happen in this cycle. What would be significant is if we see the LEIs start to roll over as the S&P continues to make new all-time highs. That would get me cautious on this chart. That's what we saw in the last cycle. The LEI index topped in early 2006, and then the equity market didn't top until late 2007. In the previous cycle, the 99-2000 top, they pretty much rolled over in sync with each other. But going back historically, it's important to say it's not always the case that the LEIs are going to be either in sync or leading the equity market. The equity market can roll over ahead of these leading economic indicators. All right, now looking at stocks in relation to the global growth backdrop, we have manufacturing PMIs. That's the Purchasing Managers Index. This is for the four largest economies in the world. That's the U.S., China, Japan, and Germany. And then the S&P 500 in black here. So just as a reminder, for PMI readings, anything above 50 is expansionary. Anything below 50 is contractionary. So I've got the dotted line there at the 50 level on the PMI's axis. Then the picture right now is that all readings are currently positive. They're all above 50 and generally trending higher. So I think that the S&P 500 in some part is likely being supported by the positive global growth outlook. To me, the biggest risk factor in terms of global growth is probably China. The China PMIs, which are in gray here, did fall below 50 in early 2015 and were somewhat of a precursor to this mid-2015 to mid-2016 corrective period in the S&P 500. Now, of course, the S&P can fall for any number of reasons, but to the extent that China is a risk factor, I think monitoring their manufacturing PMIs is one way of checking up on things. Let me go through some numbers here according to the World Bank for 2018. So U.S. GDP will account for 21.5% of global GDP. The Eurozone will account for 16.8%. I realize that Germany is not the whole Eurozone. I have the German manufacturing PMIs here, which has just been gangbusters. That's up at 63.3. But I'm using that as a proxy for the Eurozone. So the Eurozone whole as an economy, according to the World Bank, is going to account for 16.8% of global GDP, China 13.2%, and Japan 7.6%. The growth forecasts from the World Bank are 2.2% growth for the U.S. this year, 1.5% growth for the Eurozone, 6.3% growth for China, and 1% growth for Japan. In terms of the share of global GDP growth, the U.S. is expected to make up 16.4% of world growth this year, the Eurozone 8.8%, China 27.7%, and Japan 2.7%. As a side note, India, which is the fifth largest economy in the world, is expected to contribute 8.6% to global growth this year. So India is another one to watch, and right now the manufacturing PMIs there are very strong as well. So based on the expected share of global growth being at 27.7%, China is probably the biggest risk factor. All right, so in summary, right now this picture is positive or looks positive for stocks. What would get me cautious is to see any of these big four manufacturing PMIs fall below the 50 line, with the U.S. and China being the most significant. All right, now let's look at the credit market and financial conditions backdrop for the stock market. So the black line here is the S&P 500. The gray line is the Chicago Fed National Financial Conditions Index, which has about 100 sub-indicators that comprise this index, various credit spreads, as well as things like loan officer surveys, are banks tightening or loosening lending standards, things like that. Historically, in my view, and from what I've seen, credit markets often lead the stock market. Now, that's not always the case, and I want to be clear on that. However, you can see that in the last cycle, this financial conditions index did break down prior to the high in the equity cycle. They really started to deteriorate in the summer of 2007, and that preceded the top in the equity markets, which was a few months later. And then the financial conditions index bottomed in late 2008, and that was prior to the bottom in the equity market in early 2009. So I'll talk more about this on my presentation on U.S. interest rates in the coming weeks, but what's interesting is that the Fed has been raising short-term interest rates. They've hiked 5 times now in this hiking cycle, and they've started reducing the size of their balance sheet. And yet financial conditions are actually looser now than they were when the Fed started hiking in late 2015. So the idea that Fed tightening is imminently going to damage the stock market, well, we can see here, according to the Chicago Fed, that financial conditions are actually still very accommodative, and in that sense are still supportive of stocks. So the idea that Fed tightening is going to bring an end to this bull market, well, that very well may be the case, but it's not yet, and this index is one way of tracking that. Now, I know that the European Central Bank and the Bank of Japan are still conducting QE, and that the ECB is expected to wind down their QE purchases this year, and that very well may finally tighten financial conditions in the U.S. and globally, and I'm open to that as a possibility. I do think it's important to put Fed QE in the context of global QE, and one can argue that QE globally is going to hit an inflection point this year. I'll leave that as an open question to cover in future presentations. But right now, this picture looks positive for stocks. What would get me cautious on this chart is for financial conditions to tighten past the minus 0.50 level, which is right here. So if we saw that gray line trend down through that level, that would get me cautious on this picture. As I've said, the market can fall for other reasons. This was a good leading indicator in the last cycle. The thing that kills this bull market will likely be something different than what killed the last bull market. So I don't want to put too much emphasis on this. All we can say right now is that financial conditions don't appear to specifically be a headwind. All right, let's look at market breadth. And this is maybe the biggest reason that I'm generally positive on this bull market continuing until further notice. All right, so the concept of breadth deals with whether the bull market is broad-based or not. In other words, as the market cap-weighted index is making new highs, are there lots of stocks participating in that, or is it just a few? The idea is that as breadth narrows and fewer stocks are carrying the index to new highs, the bull market is getting tired and a bear market might not be far away. So you can see here on the chart, this goes back to the mid-90s, so we've got a few cycles that we're looking at here. But in general, the cycle analysis going back over the past 100 years suggests similarly that you get this weakening breadth late in these bull markets. So this chart, it only takes data readings when the S&P 500 index is making new bull market highs. And what the chart shows is that when the S&P 500 is making a new bull market high, what percentage of member stocks, in other words, what percentage of the 500 members of the S&P 500 are above their respective 200-day price moving averages? When the index makes a new high, you want to see a high degree of participation in order to be confident in that bull market continuing. Right now, the reading is around 80%, so 80% of S&P 500 member stocks are above their respective 200-day moving averages as of the last new all-time high, which was on Friday, January 12th, 2018. And you can see here that this metric was actually in the 30s at the end of the bull market in the 99-2000 top, and in the 60s at the end of the last cycle. What would get me cautious on this particular analysis of breadth is to see this reading below 65, which is the dotted black line here. Now, I think it's important to note that there are a number of ways to look at breadth, and any interpretation will involve a cross-check of other metrics. So, as of the last close, which was Friday, January 12th, all-time high close, the all-time high was confirmed by the cumulative advanced decline line making a new all-time high, the equally weighted index making a new all-time high, and the mid-cap and small-cap indexes also making new all-time highs. So the picture for breadth is very positive right now, and if history is any guide, this is not a picture of a bull market that's on its last legs, which suggests to me that the path of least resistance is for the equity market to continue to make new all-time highs until further notice. As a base case scenario, meaning on balance more likely than not, I would expect to see breadth deteriorate significantly before the end of this bull market. All right, now let's turn to the sentiment backdrop. So at the beginning I talked about my longer-term cautiousness on the market. Sentiment is probably the biggest concern that I have on the near-term outlook, as bullish sentiment is generally at elevated levels right now. So what I'm showing here in gray is the AAII survey of bulls as the percent of those who responded as either bullish or bearish. So in other words, of those that have a directional view on the market, 66% right now are bullish, meaning that they think the market will go up over the next 6 months. To put that into some perspective, the long-term average going back across this time frame, which goes back to the mid-90s, the long-term average is about 57%, and we're about one standard deviation above that average right now in terms of bullish sentiment. But we did have this very, very strong reading, almost at 80% last week, and that was a little bit of a sign of concern. This week it's dipped back down, but this is only one way of looking at sentiment. If you look at options pricing, for example, or other survey-based indicators, that also suggests that that bullish sentiment is currently at elevated levels, and that's a cause for some concern. The framework generally on sentiment is probably best summed up by Warren Buffett's saying. He says, "I want to be greedy when others are fearful, and fearful when others are greedy." So, in other words, if bullish sentiment is strong, it might suggest that the market's fully priced and that there's room for sentiment to swing the other way, causing fear among the masses of investors to bring the market down. You'll notice that sentiment can be very elevated shortly after the end of a bear market, and that's less of a concern than elevated sentiment well into a bull market. So, for example, here in 2003, you can see a very strong reading of bullish sentiment around what looks like 89% there, just after the end of the bear market of the early 2000s. And that can actually be a positive signal rather than a negative sign. But given where we are now in the cycle, I'd be cautious about seeing elevated bullish sentiment. So currently I'm cautious on this picture. I'd be more positive on the near-term market outlook with respect to the sentiment backdrop if this sentiment reading was consistently coming in below 60%. All right, now let's look at historical annual calendar year returns for the S&P. This is not a chart that I plan to show regularly, but because it's the beginning of the year, I'll cover annual returns for the S&P historically, and I'll talk a little bit about the sell-side forecast for this year. So here are the yearly returns going back to 1928. That's as far back as the Bloomberg data goes. That's why that's the time period. Now, coming into this year, the sell-side estimates in terms of expected return for 2018 were ranged from around flat to up 10%, with the average being an expected return of around plus 5% for the S&P this year. Now, just to walk through some statistics for the period on this chart, which is from 1928 through the end of last year, 2017, only 17% of the time was the S&P calendar year return within the 0 to 10% return range, which is where the sell-side forecasts are for this year. 51% of the time, the return on the S&P was greater than 10%, and 32% of the time, the market was below zero, in other words, had a negative return. The average year for this whole period on the chart was plus 7.6% per year, with the average up year being up 18.1% per year. So looking at these statistics I just went through, for me, more important than trying to make a 12-month forecast is to consistently apply my process and regularly update my outlook based on incoming data. In summary, we've covered the market backdrop with respect to valuation, the U.S. business cycle, global growth, financial conditions, market breadth, market sentiment, and historical returns. As I said at the beginning, for me it's a mixed picture. I'm cautious on the longer-term outlook. It seems reasonable to expect below-average returns over the next 10 years from the current levels on the S&P, but I'm generally positive in the near term. The business cycle, global growth, and financial conditions as a backdrop all look positive, and the market breadth is very strong as of the last readings. I see bullish sentiment at elevated levels as somewhat of a caution sign. Nevertheless, I do think that we will continue to see new highs in this bull market. The thing that I'm probably paying closest attention to watch for the timing of the end of the current bull market is to see the market breadth deteriorate. All right, so I plan to put out the equity market presentation on a monthly basis. So in a month, I'll come back and update the data, and we can see where things stand.